Major funding for this program is made possible by grants from Bank of America, Merrill Lynch, and Perfect Building Maintenance, Kilroy Architectural Windows, Inc., New York's Window Company, New York Community Bank, Capital One Bank, Greenberg Traurig, LLP. Additional funding is provided by grants from Akron Gold Brothers, LLC, Briarwood Organization, Beechwood Organization, C.B. Richard Ellis, Cushman and Wakefield, Dime Savings Bank of Williamsburg, Hal Fettner, Durst Fettner Residential, First American Title Insurance Company of New York, Friedman, LLP, Gemini Real Estate Advisors, LLC, Jack Jaffa and Associates Real Estate Consultants, James D. Kuhn Real Estate Institute at Syracuse University, Madison Realty Capital, Massey Knackle Realty Services, Meridian Capital Group, M&T Bank, Muss Development, LLC, Des Moines Group, Newmark Knight Frank, Orphanides and Associates, SJP Properties, Sterling and Sterling, Stonehenge Partners, Urban American, W Financial Mortgage Fund, the Wickoff Group.
Hello, my name is Michael Stoller. Where is the office market in 2010? 2008, it was on life support. 2009, the EMT guys brought it a little alive. 2010 may be a great year, but who knows? So I really wanted to bring together the gurus, the people who understand what's happening in the New York City office market. My guests today include the newly installed chairman of the tri-state region, Grubb and Ellis, David Arena. Congratulations on that.
Thank you, Michael.
The principal and co-founder of Broad Street Development, Daniel Blanco.
Good to be here, Mike. Thank you.
Peter Turchin, the executive vice president at C.B. Richard Ellis. And last, but definitely not least, Michael Giglio, the CFO and the director of acquisitions at the Kaufman organization.
Thank you very much, Michael.
So,
Pleasure
you know,
to be here.
you were a broker once in your life. You're a broker, but you're the consigliere. You're the king broker over there. You were a broker.
I'm still a broker.
You're still.
I'm still a broker. I'm the only one.
You're the only one. The only legitimate one over here.
I think I'm the only one.
He's
legitimate. There's no question.
He's legitimate. So my question is, as we were saying prior to the show, 2008 was a terrible year. 2009 was a good year. So where do you see 2010, Mr. Chairman?
Well,
you like that, Mr. Chairman?
It sounds nice. I like Mr. Wizard better, but Mr. Chairman is fine. So where's 2010? Let's start in 2009. End of 2008 and the beginning of 2009, it couldn't have been worse, right? I mean, it was as cold a period of time as I can imagine in our business and in a lot of others. So this year, it's much better. Obviously, and I think everybody feels better. Stock market's better, a lot more leasing velocity. But I think when you look at New York, it's a.
Wait a second. Let's not be myopic.
Okay.
We're talking about the region. Right. you run a region. There's something called New Jersey. I believe you live in Connecticut.
I live in Connecticut. I don't count it usually as a competitive office market to Manhattan, but I'm wrong most of the time. So. Not just Manhattan, but just talk broadly about the leasing market. I think it's a market of many markets, so that makes it hard to oversimplify. Some markets better than others, some asset classes better than others. But the thing I would remember in New York City, it's a market of 400 million square feet. 400 million square feet, it's got average velocity somewhere between 20 and 30 million square feet every year for the last 10 or 15 years. And that's a lot of velocity in any market. And I think for the leasing business, that makes us feel good. We make trades, there's no question. The question is, where's the pricing on those trades? And my view is it's obviously down from 2006 and 2007, but I think it trades sideways for the rest of this year.
So you lease a couple of good buildings, 399. You've had some
One or-
major
one or
property.
two.
Yeah, I mean, you've done a number of leases. So, and wait, you're even a counselor. You know, you're truly a counselor. You're an attorney who's left to the dark side. Don't worry, wait till I get to you on the dark side. So, where do you see the year? I mean, you've had a good year at leasing because you've had some tenants. Where do you see 2010?
You know, I agree a lot with David, is that, you know, we really had a fiscal bad year. And the fiscal bad year was middle 08 to middle 09. Because the beginning of 08 was actually a good year in activity. And what happened was the end of 08 was terrible. The beginning of 09 was terrible activity. I mean, if you took the fiscal year was terrible. So we've had, as a result, 2 very mediocre years because they averaged out. You know, but the last couple of months, we have seen a lot of activity. And I think the reason for a lot of activity, and we talk about it, is pricing adjusted very, very quickly in this marketplace. So we saw spaces that are priced and repriced down, and the metrics will change by how much. But the pricing is coming down 30, 35%, you know, 40%.
You know, unfortunately, too many people in the press, when they write, since they aren't in the real estate business like we are, who understand what's going on, how much are prices really down? From bid to ask, with effective rents, you know, with 3 months concession. You're a landlord. You know, your buildings, Kaufman has been a great organization. They own properties for many years. I mean, even in your buildings, how much are rents down?
On an average, I would probably say somewhere in the 15 to 20% range, maybe some as high as 25 on rentals, running
in your
from
building.
from some of the high 30s to maybe some of the mid to low 30s at this point. So whatever that range is. But I just want to qualify it. I was never a salesperson or a broker.
No, I understand.
And being a financial person, I'm always involved with the metrics of the business. So to answer your
so
question
you're the one
clearly,
who really knows. You count
answer
the
your question
pennies.
clearly, when I look at 1099s for this year versus last year, or I look at volume of our leasing company this year versus last year, I look at volume that's down on a relatively by about a third. And that was off of the 2008 year, 2009 comparison. But what I think that I can't answer is from their side, what I think that they're seeing a lot of the ripple effect of 2 things. Number 1, unemployment. Number 2, the fact that the banks can't shake loose the assets that are on their balance sheet because of all the difficult aspects of putting everything together in the legal sense of how we resolve this property. Like the resolution of these properties is only about 1/6 of the way through where it's going to be. So 2010, I think, is another transition year. And so I agree with you, David, where you said the market goes sideways. And I'm not sure how long that sideways lasts for, but I can tell you this. To the extent David and I had this discussion earlier where the values of these properties turned 5 caps into almost 9 caps, or 4 caps into 9 caps, you're dealing with half
Let's play non-inside baseball. You remember, a lot of
Sorry.
people
Right.
watch the show. The idea is how much, you know, and I tell I tell the story of a building like, I think a good example is 1515 Broadway, where they just refinanced. They had to put $150 million in equity in the deal. If you divide that by the loan to value, basically the value of the building is $380 a square foot. You got signage, you got retail, you have everything. 2 years ago, that building was worth $850 to $900 a foot. So I'm down maybe 40 to 50% in value. That's what the reduction
question.
is.
Keep it simple.
You know, now you were on the dark side. You were like Mr. Turchin, okay, and Mr. Arena, and then you became an owner. You became a big shot owner. So as an owner, tell us, where do you see the market? And then you're in my favorite place. You're in Lower Manhattan.
Thanks. Well, first, Mike, thanks for having me back.
My pleasure.
And going from the dark side, I'm incredibly fortunate to be able to go from where I was, which was the light, to maybe a little brighter light. But it's guys like these that drive the marketplace. And if you hear the metrics that are being created, it's an adjustment of philosophy and adjustment of execution. No longer can you do $100, $150 deals. Anybody who's doing those deals at those levels is not leasing. In our portfolio downtown, when we saw the tide changing, we quickly dropped our rents 20%, because the reality of it is it's back to basics in this economy, isn't it? It's about tenant service. It's about executing your business plan, meeting your tenants' needs. So in the microcosm that is New York, New Jersey, Connecticut, if you apply these axioms, just along every business line you have, you're going to do great. But to the point of valuation, I recall, as a student of real estate, the Resolution Trust Corp., where literally there were millions and millions of feet in bankruptcy. The resolution was set up so that landlords could inculcate value, get assets out of the resolution. In this instance, as you know, the securitization is so complex and so diverse, but that by the time you unravel that puzzle, you're left with just pieces and you can't put Humpty Dumpty back together again. So until such time as the services have to compel themselves to do something, then you'll see some of the transactional work. But in the interim, you're dealing with leases that I agree are at 20 or 30% differences.
Let's take a reality of situation. January 2010, a building at 4 New York Plaza, a 41-year-old B-plus building, good building, nice structure, on the water, in downtown Manhattan, trades for $97 a square foot.
Right.
So if we want to take comparables, if we go back to 2006, 2007, you take 14 Wall, which sells for about $380 a square foot.
That's
right. 26 Broadway, which sold not for a land lease, for about $370 a square foot. We're down to $97. The land, you couldn't buy land before for $97 a square foot.
That means where's the needle today, right?
Where's the needle today?
Right, where's the needle today?
And if they didn't have a J.P. Morgan lease, they probably couldn't have even sold the building for that price.
So what you're saying basically, unless there was a credit enhancement of a quality tenant like that, that transaction wouldn't have been consummated. The needle wouldn't have moved. So on a valuation perspective, cap rates have moved at least 200 to 300 basis points. 5 cap, 4 caps, even on value added. Now, I will say, however, that I guess the good news is if you look at the most recent transaction was UBS, right? When that position was sold, I mean, what were the metrics on that? Does anybody?
The property on UBS, it sold for $625 a square foot. But you know what? You're not taking apples to oranges.
No, but
you're taking Park Avenue, a prime property on Park Avenue in Midtown.
No question.
Where people want to be.
The point I'm trying to make
with a tenant of UBS for 8 years.
But here's the metrics. Right, the metrics there that has to be respected and honored is that a transaction occurred, velocity occurred, something occurred. So to the point that there is opportunity, they are there.
That's all, you know what, pros and cons. I don't want to get to the discussion of that, but there was mortgage in place, and as Peter said, there was a great situation.
My point is both were credit enhancement deals.
Yeah. Well, let me say something about downtown Manhattan. To me, it's like a tale of two cities, right? There's the east side and the west side. And first of all, that trade I think ends up being a double for Harbor. I think they made a smart trade. $100 a foot, you're right. You can't buy the land, you can't recreate the building. But that's got an odd facade built, for a different period of time, punched out windows, a lot of work that has to occur to
We can make it a prison.
We could use a prison. That's not a bad idea, an adaptive reuse. But that side of town, I think, is suffering right now.
But you bring up a good thing. You got 2 buildings downtown. They are B+, A- buildings. They're good buildings. They're not AA on Battery Park City. But we have a circumstance that you have buildings, a number of buildings in we call Fashion Center, Garment Center. You call them Penn Plaza. Whatever we want to call that area. But in Times Square, someone called it Times Square South in the previous show. So if I'm a tenant, you're talking 2 cities. Is it a great time for a tenant? You've leased lots of space recently.
I think it's a fantastic time for a tenant, and I think you're seeing 2 good things. One is I think you're seeing tenants lock in for very long, and they realize the value in the market. And the other thing is, which is an interesting part, is you're seeing tenants want to get into this market that naturally wouldn't be in this market.
Absolutely.
Where a year ago, if a tenant had a lease coming up in 2 years, as the market was going down, they said, don't talk to me. I'm waiting, I'm going to hold, I can wait till the last possible minute.
Absolutely.
Because every minute I wait, I know I'm going to lock in term.
The catch and the falling knife theory.
Now you're seeing these tenants, and not just, 010, 11. You're seeing 012, 013, 014, talking to their brokers and say, how do I get into this market? And how do I become a part of this market because I know it's a good market?
Which is good for people like you and you, because people are saying, let me seize the opportunity and get a good lease. Now, what we were saying also before is that a tenant and a good broker, that the guys like you are only bringing your tenants to well-capitalized owners, because you want to make sure that the building is not going to be taken over by the bank. You want to make sure that they can handle the properties. They're going to run the property correct. There's not going to be difficulties on that.
We're finding that we've become more of an attractive owner because the news is out there that, whereas in the past you weren't able to see whether or not an owner was well capitalized or it wasn't a part of the equation as to where you're going to lease space, we're starting to see not only our own tenants saying to us that we're good landlords and that we're not levered. We have 35 buildings, 21 of them don't have any debt on them. So we're able to be flexible in terms of the market. What I do see about our opportunity now is to take these tenants, move them into spaces that really make sense for them, give them better build-outs, give them a work letter that you could stand on. There are some landlords now that you're looking at that you can't even rely on them for a work letter.
Yeah.
Mike, see, that goes back to my point.
You
of
get an
back to
LC
basics.
going the other way from the landlord to the tenant saying, "I'll put up an LC for your work letter." That's what is starting to happen
I've
in the
seen
market.
that. I've seen a sub-landlord in this last year have to post a letter of credit.
Tenants are not only focusing on that flight to quality, but also the flight to the quality financial of a landlord.
Well, it used to be that you wanted a subordination non-disturbance from the lender. Now they're saying that if you're well capitalized, we want to see the capital stack, and if you're doing well, it's a sigh of relief. It's yet another checklist point when they look into a space.
A very interesting short story, because I wanted you people to talk more than me. About 2 years ago, a very successful person, had retired. He was chairman of a company, and he wanted to move into his foundation and his other business into a Class A building, and he was ready to take space at 1330 Avenue of the Americas. It was Maglow's building, and he said, "What do you think?" And he said, I met with them. I said, they're good people. I said, but you know what? Buyer beware. I was right. He was right. He never signed the lease. And because, and the building was finished, but it might have not been finished depending on who the borrower is. New Jersey, Connecticut, what do you see happening?
Well, there's activity. I think it's just like New York City. There's activity. There's velocity as markets are big enough. It happens when the prices get to the right zone, and I think what Peter said before, they're in the right zone. It's a great time for tenants, the best time in my lifetime maybe for tenants to make deals. I think Jersey and Connecticut and outside of Manhattan offer something to tenants that maybe Manhattan doesn't. Access to a different labor pool, a little lower real estate costs, so still attractive. Probably will be used more and more as a stalking horse for tenants who are looking for public incentive packages here in New York City.
Good point. And
to
Michael?
support your point, some of the metrics that are this new RR, this recovery rate ratio that the banks are looking at, which is basically say, I loaned you $100 million. My recovery rate for a suburban building is better than almost any of the other buildings. In other words, you'll get more cents on the dollar on that loan when the bank goes to sell that loan to an independent third party.
Now, but an interesting situation in Connecticut, Starwood got basically from the tenant, from the landlord, and from the state close to $45 million of incentives to move there. And in New Jersey, Depository Trust is moving to Jersey City, and that was a $76 million tax incentive to leave Lower Manhattan. And in Lower Manhattan, they still had REIT benefits. Yeah. So, where is, if I was a tenant coming to both of you, where would you recommend? I mean, how do you, what would you say? Should they go to Midtown South? Should they? I think
what drive. Well, listen, Peter will have I'm sure a knowledgeable response as well. What drives tenants is really labor. The first thing is labor. So who are you trying to recruit? Where are your clients? Is image important? Do you need to be in an image building? Do you need to be in Midtown Manhattan? Do you need to be in an A tower? Who on your team needs to be there? What functions? The front office facing revenue producers, do the back office support, technology ops, administration, can they be somewhere else?
But why shouldn't they move to Dan's building in Lower Manhattan where they can get a REAP benefit, a relocation of close to $12 a square foot to go over there? I mean, unless they need the class of being at 399 or Park Avenue or something like that, why shouldn't they try to save money?
I mean, look, for those industries that how they support their business that can, I think downtown is a great alternative, but it has been an issue because the spreads have come down.
Absolutely.
Because the spread, everyone talked about the spread between downtown and Midtown and how wide it was.
Which is traditionally what causes the velocity downtown. Midtown gets to a 50%, 75%, 80% more expensive than downtown. The overflow process, the tale of two cities comes into place. Exactly what Peter just says occurs. Then the migration comes downtown. And then the rents you have lift on the rents. So what I was saying before is the metric that's caused the velocity is just pure price adjustment, right? There comes a point, the tolerance level goes, and then they bite.
But if you take Michael's, the Kaufman properties, a lot of them are near Penn Station and the Port Authority. That's a very attractive thing, having the opportunity.
The hub of transportation is critical to some tenants.
Absolutely.
And that is a consideration, especially when you get the chairman of the board who decides that he lives on the west side and he wants to commute to the west side and he wants it to be 10 minutes.
Or he lives in Saddlebrook.
And he's going to make the
wants-
ultimate
exactly.
decision on the space for
Transportation
Paragon or whatever
is
company
more
it is.
and more, transportation is going to become the big issue. So clustered around transportation hubs, on subway lines.
But the interesting situation, I think I read in one of the research studies that just came out, is that Grand Central had the lowest. They didn't do that well in leasing in the fourth quarter. The Grand Central market.
It's possible, but I would tell you first of all, in the Grand Central market.
Go on.
No, go ahead.
No.
A lot of smaller spaces, right? Floor plate smaller. So depending on who's out looking in a particular quarter, I think that could show up in the statistics, although they bear looking at. But I think more and more transportation hubs are going to be critical, not that they haven't in the past. And so that's why I like downtown long term. I think you're going to have the greatest transportation hub in Santiago Calatrava Design Station there. Certainly in New York. Maybe in the country.
You have a lease coming up. So when is Grubb and Ellis going to move downtown?
You know what?
You like that one.
I think it goes back to labor, right? Where does your labor come from? So if your labor is oriented
Touche.
to the
You
north
gave-
or
you-
the
Where does
west,
his labor go to?
No. I think that's a great comment, and I think that is the point. My wife's in the employment business. A lot of people who live in Staten Island and Brooklyn like working in Lower Manhattan if they're in the Secretary of the Administrative, because it's more convenient. People from New Jersey love working in the Fashion District
Or Long Island, because the railroad's
because
right
the
there,
railroad's
too.
over there. People who live in Connecticut, they like Grand Central. I didn't say.
It's amazing. People, if you look at tenants, how accustomed they become to their surroundings. And you look at any company where they are, and automatically most of the people end up commuting and living around the environment of where they are.
Yeah.
And you start looking at those companies, it becomes a hard thing to move a lot of those companies out, because what happens is the longer you've been there, the more people are ingrained to that commute and that location. It's a very, very difficult thing to do.
But I'll tell you this year, you're going to see, next year, you're going to see a lot of changes that are not apparent in the way people occupy space, right? So a very big change I think is going to occur in the banking business. There's a lot of changes at the very top of these financial institutions.
Do you think they're going to take more space or less space?
I was thinking more like, I think there are going to be people who are out in the suburbs who are actually going to want to get back into the city, large firms.
That's interesting.
I think if this whole conversation today with Obama and Glass-Steagall, right? If that comes back, that's going to cause a whole nother reverberation in that business, separating banks and investment banks and commercial banks. So Citi and JP and others have issues. I think in the next 2 years, the banking business, like it has been for many years, is going to be a catalyst for growth here in Manhattan. And it's going to be in ways that are not apparent today.
It's funny because we talk about flight to quality, and we talked about that a lot. But flight to quality really isn't just Class B to Class A. Flight to quality is going from an area probably not so close to a transportation hub to one right by a transportation hub. It's from going from lower floors in a stack to higher floors in a stack. So, flight to quality means a lot of things.
You could be staying in your own building, have a work letter, wind up getting your space improved, not having to deal with the headache of actually moving, and get your rent lowered. That's flight to quality, even though you haven't moved from the same building.
People don't realize, I mean, my company, we were thinking of moving, my colleagues said, I said, look, keep the space. You don't have to move your computer services, you don't have to move your telephone, you don't have, there's a lot of expense, and fortunately we were able to do that. So if, if we were here in December of 2010, where would have been your projection on how the leasing market and pricing for the end of the year? I know the apples are over there, so I don't have my crystal ball over here.
The leasing market and pricing, as far as leasing goes, these gentlemen could certainly tell you better. But as far as pricing of the assets, I think you're going to see a lot of shakeouts, banks trying to clean up their balance sheets, properties coming back in at the metrics that work, the good, the fundamental, traditional underwriting. How does a property work and be able to afford itself a 20% IRR? And I think you're going to see things come back on a slow, conservative basis. I think
Peter.
We talked about activity, and activity is up. So the first thing that always has to happen is activity. I've always told everyone, you don't get pricing without activity. That doesn't happen.
We don't have much time. Give me your...
I think that in a year from now, I think that activity will be probably the same levels we're seeing per month that it is now. Absorption, which is the next part, will be better, meaning our availability rate will be lower, and I think pricing will be slightly up.
Daniel.
2010, if I was sitting here in December, I would say that it's going to be...
Depends if you're nice. You may be.
I only hope to be to you, Michael, because we love you. I would say that it'll be more of 2009. I think you're going to see a lot of renewals. I could definitely see another drop 5 to 10% in rents, but for the most part, more of the same in 2009.
Last but not least, with very few seconds left, Mr. Chairman.
Prices,
congratulations again.
Thank you very much. Prices trailing up for A assets, flat to down for B assets. There'll be a lot more assets for sale by the end of 2010, and there'll be a lot of new millionaires made.
I'd like to thank David Arena, Dan Blanco, Peter Turchin, and Michael Giglio. See you next week.
Major funding for this program is made possible by grants from Bank of America, Merrill Lynch, and Perfect Building Maintenance, Kilroy Architectural Windows, Inc., New York's Window Company, New York Community Bank, Capital One Bank, Greenberg Traurig, LLP. Additional funding is provided by grants from Akron Gold Brothers, LLC, Briarwood Organization, Beechwood Organization, C.B. Richard Ellis, Cushman and Wakefield, Dime Savings Bank of Williamsburg, Hal Fettner, Durst Fettner Residential, First American Title Insurance Company of New York, Friedman, LLP, Gemini Real Estate Advisors, LLC, Jack Jaffa and Associates Real Estate Consultants, James D. Kuhn Real Estate Institute at Syracuse University, Madison Realty Capital, Massey Knackle Realty Services, Meridian Capital Group, M&T Bank, Muss Development, LLC, Des Moines Group, Newmark Knight Frank, Orphanides and Associates, SJP Properties, Sterling and Sterling, Stonehenge Partners, Urban American, W Financial Mortgage Fund, the Wickoff Group.